5 AI stocks that have gotten beaten down dramatically in the past month or so, but still have massive growth opportunities. And no, these are not all semiconductor stocks. We're actually going to look at one semiconductor, two software players, one healthcare, and one cloud server provider. Let's take a closer look in today's episode. All right, so today's episode might be a bit long. We're going to look at 5 stocks. And remember, no investment is ever guaranteed. So these are stocks that have taken quite a hit, as we're going to see, but do have growth opportunities. But on today's episode, we're going to look at both the bearish and bullish side to try to understand some of the main risk and some of the main growth opportunities that all these companies are facing. Now, the first one is going to be Intuitive Surgical, ticker ISRG. Now, this is going to be one in the healthcare market. Now, this is one that has always caught my attention because it's focusing in the robotic space with medical surgery. And I believe the future, with the type of data that they collect, in the future, we're going to have more AI edge and AI initiatives in programs like this. And companies that both have a product already running in some form of robotics platform and also are collecting a lot of data with the various amount of sensors their platform has a strong ability to produce some great products in the AI market. So in year to date, the stock is down roughly 14%. From its overall 52-week high, the stock is down roughly 26%. Now we're going to be looking at some charts and we can see forward PE ratio right now is sitting at 52.15. Now, when we look at the overall median, and that's my favorite concept, is looking at the median, it usually trades at 58. So this is a company that historically trades at high valuation. Now, compared to its typical high valuation, it is trading a bit cheaper right now. So this is definitely kind of keeping a closer eye on. Now, before we continue, I found this super quick method for getting new ideas on stocks to research, and I want to show you how I do it with Mumu, our sponsor today. Quick heads up though, the stocks I'm showing are just for demo, not investment advice. You know me, I'm huge into the semiconductor and AI market, but I don't know all the stocks. So here on Mumu, I can go to markets, stocks, investment themes, and start looking at all the different themes. Some AI focus, some outside my wheelhouse. Let's look at this, NVIDIA's portfolio, and see all the companies NVIDIA owns right now. We can also do this for ETFs and find ETF-based ideas on themes that we enjoy right now. Outside of this cool feature, we have partnered together and have an amazing sign-up offer for the semiconductor AI community. Right now, Mumu is giving new US users up to $1,000 in free NVIDIA stock just for opening and funding an account. Up to $100 in cash reward. And as if that wasn't enough, you also get a massive 8.1% APY on your cash for limited time. Click the link below to learn more and take advantage of Mumu's amazing offer today. Then we looked at those charts. I kind of want to explain what's happening here. So in the past 3 months, the company has seen, and just the past year, has seen a nice amount of negative drawdowns in the forms of stock price. One of the first things is just tariffs. There is margin compression happening from current and potential future tariffs. Then we're also kind of moving into the Da Vinci 5 ramp, and that's creating volatility around solid placement numbers. And then we've also recently heard some headlines of layoffs and competitors entering into this market, which also softened some of the demand. So let's start off here with the tariffs. So in the tariffs in April, ISRG did warn investors that tariffs would create about 170 basis points of margin pressure. They estimate that 2025 cost of sales would increase by 1% of total revenue, causing a guidance cut and persistent uncertainty. Now, most recently, on September 3rd, the CFO described a dynamic tariff backdrop, suggesting that the impact can grow into 2026, causing the stocks to sell off more. And on September 25th, a new U.S. Commerce Department probe into medical devices imports reinforce tariffs uncertainty. Now, before we look a little bit more, if you are enjoying the episode, it's going to be filled with a lot of data. Make sure to hit the subscribe button. I'm trying to hit 85,000 subs by the end of the year. I do have a free AI semiconductor newsletter, whatthechip.com. Now, continuing with the bear case, and one of the biggest bear case is just the valuation. Like we saw, this usually trades at a premium. We saw it was closer to like 52 right now, but that's on forward PE ratios. And we're seeing margin compressions. Tariffs have put gross margins below the mid 60s. Tougher competitions. You have CMRs, you have Johnson and Johnson's, you have Medtronics, could put pressure on pricing and placement. Hospital budget constraints are also crucial right now as capital placements becomes a little bit lumpy as they juggle IT spending and outpatient build priorities. And you also have just execution risk, right? The choppiness of the Da Vinci 5 rollout. Now, the bull case is there's a huge install base, roughly 10,488 systems as their most recent earnings, up 14% year over year, which creates a multi-year Da Vinci 5 upgrade cycle and reoccurring revenue flywheel. The second is durable procedure growth. The guidance of 15 to 17% for 2025 reinforces a stable, high margin, reoccurring revenue stream. You're also seeing international expansion. They mentioned Da Vinci 5 unlocks wider European adoption where penetration is still pretty low, and they are improving their overall software, which can help kind of force some form of moat within the software ecosystem. Now, a lot of great things are happening with the DB5. Utilizations are improving, feedback is improving, computing power is better. And like I mentioned, one thing that gets me pretty excited is that eventually Da Vinci can be kind of some form of AI robot with the way AI technology is going. Now, the other thing in a long-term growth lever is right now robotic procedures represent only 2% of all surgeries performed globally. So this is a massive growth opportunity for the company. Now, they are expected to report earnings on October 21st. So this is one that could be very volatile after earnings. Usually, I like to wait after earnings, but in the long term, I do believe there is some opportunity. Now, Da Vinci, what you're going to see is how is Da Vinci's 5 doing? Are they accelerating? How is the trading cycle progressing? Now, on the bearish side or the bullish side, what is the commentary on margins? Any updates on the impacts from tariffs or the Section 232 probe? Is it going to impact this year and next year? What are we seeing? Also, kind of the competitive milestones, updates on trials or commercialization of the competitive landscape right now could help create some negative tailwinds as well. So I believe this is one of those stocks that I'm going to keep doing research on, but definitely has the opportunity. And the current drop gets me excited, especially since it's trading somewhat below its overall median. Now, the next stock is Adobe. And Adobe right now, year to date, is down roughly 24%. Now, from its 52-week high, the stock is down nearly 40%. I think that is wild. Now, when we look at charts, Adobe's forward PE ratio is trading at 14.6. The median is around 30.3. This is crazy. I really do believe Adobe is one of those stocks that is trading extremely cheap. But I think that doesn't matter as long as the market sentiment continues to be what it is right now, where the market believes AI is going to eat Adobe's lunch and dinner and breakfast and leave Adobe starving. But I don't believe that's going to be the case. Regardless, the market doesn't care what I think. It cares what the overall market thinks. And I don't think that sentiment is shifting anytime soon. So by the numbers, we see that Adobe continues to underperform the overall market. Now, we've seen a few analysts downgrade the overall stock. For example, Morgan Stanley downgraded it on September 24th of 2025, kind of citing that the revenue growth directionally has diverged from the pace and quality of innovation being embedded within the product portfolio. To be honest, and they reduced the price target from 520 to 450, and they reduced the rating from overweight to equal rate. So that's creating the pressure here. I'm going to say lately, I've actually seen Adobe put more models into their platforms a lot faster. So it seems like it's actually the opposite of what this analyst is saying. Now, what's been pressuring Adobe? The first is just competitive AI shock. We have kind of like Google's viral Nano Banana image editor surge while Firefly's downloads fell, fueling fears that free AI undercuts Adobe's paid model. You kind of see those analyst downgrades as AI is eating software narrative. And I do believe that narrative is going to happen, citing slower than hoped AI monetization and just pricing and product friction. As Adobe tries to figure out AI, many are fearing that this is going to create backlash. It's going to create increased churn rates, even if it increases the average revenue per users. Now, the bear case is super, super simple. Bears argue that Adobe faces permanent disruption, not a temporary downturn. The core thesis, generative AI democratizes content creation, making Adobe's complex, expensive software obsolete for many. Now, the bull case is bulls argue that the market is overreacting, pointing to real AI monetizations, deep enterprise integrations, and compelling valuations. I believe that both are right. So when I mean that both are right is I don't believe Adobe in this new market is going to be worth that forward PE ratio of maybe 30s. But I also don't believe it's worth that 14. I think right now it's undervalued. So I think both can be right where it might have been trading expensive before, but now it's extremely cheap. Maybe we can stay at a forward PE ratio of the mid 20s opposed to the 30s or low 30s as well. Now, some of the under the radar things is the explosive demand of AI and emerging markets are still there. For example, in Adobe, they're seeing Creative Cloud units growing 50% in India. Adobe Express at enterprise inflection. Express is seeing a 4x increase in enterprise adoption year over year and deepening enterprise penetration. One Adobe cross-closed deals grew 60% year over year, and over 40% of the top 50 enterprise accounts had doubled their ARR spend since the start of fiscal year 2023. Now, what to watch next? We do have Adobe event on October 28th. Kind of see maybe some information of new AI monetization, of some cool AI tools. For me, though, I believe the critical question, and this is the $1 trillion question, the next 6 months are critical to see if Adobe can monetize AI fast enough to offset erosions in its core business and prove that AI is an expansion, not a disruption. I personally believe Adobe is going to do it. Right, I mentioned that I'm seeing their models in a lot of their a lot of different models. For example, Gemini Banana is available in Adobe. I believe Sora and VO3 are already available in Adobe. If you are a major enterprise, you're not going to want to have all these software solutions everywhere, right? You're going to say, you know what? I'll rather pay the extra premium. I have my creators just work on this one platform that has everything together. And I think that's going to be a strength that Adobe has, plus the data, plus the licensing, plus the ecosystem, plus the education, and anybody who's probably working in some form of content creation, design side, is working with some form of Adobe platform. And like I mentioned, I am seeing Adobe move a lot faster rate than they were a year ago. So Adobe is one that I really do enjoy a lot, but it's one that the stock could just be extremely quiet for the next year or so as if the market sentiment continues this way. But in forms of valuation, I believe this stock is extremely, extremely undervalued. Now we're going to look at Astera Labs. So this is going to be the first semiconductor stock we're looking at right now. Now, in the past month, the stock is down roughly 34%. From its overall 52-week high, the stock is down roughly 36%. But luckily, year to date, the stock is up 18% in the past year, up 137%. So Astera Labs helps produce a form of connectivity solutions that helps communicate with GPUs, CPUs, and a lot of other integrated systems. Now, one of the main range of revenue is called through their PCIe connectors and their retimer solutions. Now, not to get technical, I'm just going to go on in a very top level space here. this market is shifting. The kind of performance you're getting on PCIe is not it's not the type you need for massive AI workloads. And we're seeing a shift of companies to move into things like UA Link or NVLink, which reduces the amount of PCIe slots and connectivity needed. So there is this fear that the components of Astera Labs might be phasing out or might not be growing as fast as they were before. Now, luckily, Astera Labs is working with a lot of those platforms. They're working with NVIDIA on NVLink Fusion. They're actually working on being a partner with UA Link as well. So they have their hands in there as well. But the competition is just a little bit more fiercer than where we were about a year ago. Now, this is a stock that's still trading at heavy valuations. The stock right now for PE of 92.77. The median is around 71.45. In the forms of competitive landscape here for UA Link and for other types of connectivity solutions, you have a lot of big players. You have titans like NVIDIA with NVLink. You have Broadcom with a lot of their connecting solutions. You have Credo. You have Marvell, which recently Marvell mentions that they're expanding into this market even faster and faster. So the competitors are there, especially with this new push. And that's enough of a bearish case to really put a lot of this heavy valuation company to take a massive, massive hit. Now, the big bullish case is capital expenditure in hyperscalers continues to grow. This company is also improving their Scorpio switches, their Leo CXL controllers. They're also improving and adding themselves into, like I mentioned, UA Link and expanding partnerships, joining, for example, ARM Total Design to enable custom AI silicon broadening routes to design wins. So the conclusion, the point is here, which is going to happen in the next few months? Are companies going to shift out of Astera Labs components and move into more verticalized risk? And if those verticalized risk, obviously Astera Labs can still be implemented within them, but the competition just becomes a little bit harder. It intensifies with companies like Broadcom, with Marvell. The bull case is right now we are still in a really nice upgrade cycle of PCIe 6. You're seeing that overall AI CapEx growth. You see open standards that Astera Labs is in gaining tractions. So this, in my opinion, is probably the riskiest out of the three that I've mentioned so far. And I think out of the five, this is the riskiest one. And the one I probably wouldn't touch because I do believe there's other players out there, but I did want to bring it up to the viewers. Now, the next two stocks that I want to look at, and I've probably gone pretty long, are ones that I've talked about in my top buys for October. And I'm not going to go that much into detail. So Amazon right now, 213. If we look at forward PE ratio right now, currently at 30.82, where the median, I'm looking at the median because it eliminates this noise. It eliminates any crazy values. The median is 41.81. So right now we're trading way below that. And I believe there's a lot of growth opportunity with their AWS. I think we have growth opportunities with their subscription, with their advertisement. We have a lot of growth opportunities with Anthropic AI. We have a lot of opportunities with their own silicon solution, the Trainium and Inferentia. So for me, Amazon is one that I don't mind getting into. It's a MAG, it's a big player, but I do believe the growth opportunity based on valuation is there. That one I don't own yet. The other one that I talked about in October is one I recently purchased, and it was Synopsis. Synopsis is ticker SNPS. Now, Synopsis is a software player. Currently, is trading 34.75 forward PE ratio, median of 37.89. Now, it's not, I don't just look at forward PE ratios, right? I need to understand the business. Synopsis is a company that helps design AI chips or helps design the define process of chips. I think this is very, very critical, especially as chip design becomes even harder and more unique, especially with things like advanced packaging. the different types of players in this space. Synopsis increases its IP solutions as well. It's recently made that acquisition of Ansys. The opportunity here is strong, in my opinion, for a software player that can benefit dramatically from the AI race, but not just the AI race, the various innovations happening in the semiconductor industry. In the short term, you have a lot of headwinds, and I've talked about that in my videos, but kind of like headwinds from China, headwinds from IP business. Regardless, I think those are short term things and not long term things. So I hope you guys enjoyed today's episode. If I was to rank them in forms of my favorite, I think great opportunities for me and safe opportunities. So safe, the safest, and I believe can outperform the market would be Synopsis and Amazon. I think Amazon would be number one and Synopsis would be number two. Then I think Adobe would fall in that one where it's completely undervalued, but that doesn't matter. That doesn't matter until the market changes its perspective. I think Adobe has a lot of opportunity based on its valuation. ISRG is one that's taking a lot of short-term risk because of those tariffs, because of margins, because of recent commentaries. But their growth opportunities is, in my opinion, very strong thanks to future AI potential. Like I mentioned, AI robotics is going to hit really, really hard. And I think in the medical business, ISRG has a lot of data points, has a lot of tech that can eventually make it grow. So it's one of those Hail Mary style plays with at least a decent business already. So it's not like a pure YOLO play. It's a great business with short-term headwinds, but a massive, massive long-term potential if executed right. Now, Astera Labs is probably the one the least favorite of. Very hefty valuation in a market that's starting to get a lot more competition. Now, obviously, this market can grow so much faster that even if you have competition, it doesn't matter. But for me, out of the five, that's probably my least favorite, but I still wanted to bring it up here into the viewers. So I hope you guys enjoyed today's episode. Take care, have a good day, and see you all next time.